For many married retirees, $1.2 million to $1.5 million of projected pre-tax retirement money is the zone where a Roth conversion taxed at 22% or more deserves far more skepticism than the standard advice suggests. A $100,000 conversion taxed entirely at 22% creates a $22,000 federal tax bill before state tax. If that conversion also crosses the first Medicare income surcharge line, a couple with both spouses enrolled in Parts B and D would pay approximately another $2,297 under the 2026 premium schedule. That opening range is an illustrative screening zone, not a universal threshold. Your real crossover is not a sacred portfolio number. It is the point where the full price of converting the next dollar today becomes greater than the future tax cost that dollar was supposed to eliminate. Think of this as a two-column ledger. The left side says, pay tax now. It includes ordinary federal tax, loss deductions, Medicare surcharges, displaced capital gain space, possible health insurance subsidy losses, state tax, and the investment growth lost on money sent to the government today. The right side says, pay tax later. It includes your projected pre-tax balance when required distributions begin, the income already sitting beneath those distributions. Social Security, taxation, the possibility of one spouse eventually filing as single, and the fact that a required distribution consumes tax capacity before you can make another conversion. The decision rule is one sentence. Convert while the all-in price of the next dollar today is lower than the expected price of withdrawing that dollar later. Stop when those prices cross. That sounds obvious. The tax system has done an impressive job of making it feel like advanced physics. The balance range becomes more useful when you translate it into required income. At age 73, the standard IRS divisor is 26.5. A projected balance of $1.2 million produces an initial required minimum distribution of about $45,300. $1.5 million produces about $56,600. At age 75, the divisor is 24.6. Those same balances produce approximately $48,800 and $61,000. Those are meaningful withdrawals, but they are not automatically a tax disaster. They become expensive only after you stack them on the income already occupying your future return. A pension, interest, dividends, taxable withdrawals, and the taxable portion of Social Security can leave plenty of cheap bracket space or consume nearly all of it. That baseline income is why two households with the same IRA balance can reach opposite conclusions. A $60,000 required distribution sitting above $30,000 of taxable income is different from the same distribution sitting above $120,000. The account balance creates the withdrawal. The income underneath it determines the price. There is also no longer a federal tax rate countdown forcing you to convert before an automatic 2026 increase. The anticipated jump from 22% to 25% and from 24% to 28% did not occur. Federal legislation enacted on July 4th, 2025 made the current individual rate structure permanent unless a future Congress changes it. So the old argument that you must convert before the Tax Cuts and Jobs Act brackets expire is obsolete. Your conversion is no longer racing a scheduled federal deadline. It is competing against your personal future marginal rate. I built a digital book called The Exit Code because that personal rate depends on how traditional, Roth, and taxable accounts overlap across your retirement years. The link is in the description if you want the framework I use to map that tax diversification window. Now, the left column can be priced properly. For a married couple filing jointly in 2026, the 10% bracket ends at $24,800 of taxable income. The 12% bracket continues through $100,800. The 22% bracket runs through $211,400, and the 24% bracket continues through $403,550. The word taxable matters. These boundaries are not based on your gross income, and they are not the same as the modified adjusted gross income used for Medicare. You are dealing with several gauges on the same dashboard, because apparently one would have been too humane. A conversion stacks on top of the ordinary income already on your tax return. If your taxable income before the conversion is $80,000, the first $20,800 of conversion can remain in the 12% bracket. The next dollar enters 22%. That boundary is not a target, it is a price change. Filling the entire 22% bracket can be sensible when the future withdrawal would face 24% or more. It can destroy value when the future withdrawal was likely to land at 12%. The phrase, fill the bracket, is not a strategy until you know which future bracket you are buying your way out of. If you want more retirement math built from the actual rules rather than slogans, subscribe. Deductions create the next layer. In 2026, an eligible married couple with both spouses at least 65 and taking the standard deduction can potentially shield as much as $47,500 before federal income tax begins. That total starts with a standard deduction of $32,200. The existing additional standard deduction for two qualifying older spouses adds $3,300. The temporary enhanced senior deduction can add another $12,000 if both spouses qualify and their income remains within the limit. That $47,500 shield is a current year maximum, not a permanent promise. The enhanced $12,000 portion is available under current law only through 2028. It is also income limited. Your future RMD calculation should not casually assume that temporary deduction will still exist 10 years from now. Even so, the shield demonstrates why a moderate pre-tax balance does not automatically generate high bracket retirement income. If a couple eventually receives a $50,000 required distribution, much of that withdrawal may be absorbed by deductions or lower brackets, depending on the rest of the return. An aggressive conversion can pay 22% today to eliminate a future withdrawal that would have used 12% space. You have not created tax savings. You have purchased a lower future account balance at a higher tax price. The temporary senior deduction also behaves differently once modified adjusted gross income rises above $150,000 on a joint return. Each eligible spouse's $6,000 deduction is reduced by 6 cents for every additional dollar of modified adjusted gross income above that line. When both spouses qualify, the household's total deduction falls by 12 cents for each extra dollar. It disappears completely when joint modified adjusted gross income reaches $250,000. Suppose a conversion moves a qualifying couple's modified adjusted gross income from $150,000 to $200,000. Each spouse loses $3,000 of enhanced deduction, so the household loses $6,000. That phase-out is not a direct 12% tax. It adds taxable income. If the additional $6,000 is taxed at 22%, the conversion creates another $1,320 of federal tax beyond the tax calculated on the conversion itself. Inside that phase-out range, a nominal 22% conversion can therefore carry an effective federal marginal cost closer to 24.64% when both spouses are losing the deduction. At a 24% bracket, the phase-out adds 2.88 percentage points. The tax bracket on the chart is the visible price. The deduction interaction is part of the receipt. Medicare can then turn a gradual tax calculation into a cliff. For 2026 premiums, the first income-related monthly adjustment amount begins when joint modified adjusted gross income exceeds $218,000. Modified adjusted gross income for this purpose generally means adjusted gross income plus tax-exempt interest, and a taxable Roth conversion enters the calculation. Under the 2026 schedule, the first tier adds $81.20 per month to Part B for each enrolled person. It also adds $14.50 per month to Part D. If both spouses are enrolled in both parts, the combined household surcharge is $2,296.80 for the year, which I rounded to $2,297 at the beginning. If only one spouse is enrolled, the cost is roughly half. If you do not cross the line, the cost is $0. If you cross it by $1, the full tier can apply. That does not mean every conversion near the threshold is wrong. Paying a $2,300 surcharge to prevent tens of thousands in future taxes can be a good trade. Paying it to eliminate withdrawals that would have remained in a lower bracket is not. The timing is delayed. Medicare generally uses tax information from 2 years earlier. A conversion reported on your 2026 federal return would ordinarily affect the income determination for your 2028 Medicare premiums. The $2,297 figure is the cost under the 2026 schedule. It is not a guaranteed 2028 amount. The thresholds and surcharges for 2028 will be determined under the rules and premium schedule in force then. That delay is why the bill feels disconnected from the decision. The conversion happens now. Medicare sends the reminder 2 years later after the tax has been paid, and the conversion can no longer be recharacterized back into a traditional IRA. A different opportunity can be displaced without producing a separate invoice. In 2026, a married couple can have taxable income up to $98,900 and remain in the 0% federal bracket for qualifying long-term capital gains. Ordinary income fills the lower portion of the tax stack before capital gains sit on top. A Roth conversion can therefore push gains that would have been taxed at 0% into the 15% capital gains bracket. Imagine that you have enough room to realize $30,000 of long-term gains at 0%. A conversion uses that room instead and pushes the full $30,000 into the 15% bracket. The opportunity cost is $4,500 of federal capital gains tax. The conversion did not directly tax those gains as ordinary income. It displaced their 0% space. That distinction looks technical on a tax return and feels identical in your bank account. Gain harvesting can also raise your cost basis, giving you more flexibility for future withdrawals. Conversion income and realized gains are competing for the same low tax space. So you need to decide which use of that space creates more lifetime value. And 0% capital gains are not invisible for every calculation. They can still affect adjusted gross income, Social Security taxation, Medicare surcharges, and health insurance subsidies. There is no single magic bucket. There are coordinated trade-offs. Before Medicare, the health cost branch changes. For qualifying households buying coverage through the Affordable Care Act marketplace, premium tax credit eligibility in 2026 again ends above 400% of the applicable federal poverty level. For a two-person household in the lower 48 states, think of the cliff as roughly the mid-$80,000 range, often rounded to about $87,000 depending on the poverty guideline tied to the coverage and tax year. Alaska and Hawaii use different figures, and you need the exact marketplace number for your household. A conversion counts toward the income used for the premium tax credit. Crossing the limit can eliminate the credit rather than gradually reduce it. After 2025, there's also no general repayment cap protecting you when advanced premium credits exceed the credit ultimately allowed on your tax return. If your marketplace received $10,000 of advanced credits on your behalf and your conversion makes you ineligible, your repayment exposure can reach the full $10,000. For older pre-Medicare households in expensive counties, the amount can be substantially larger. IRMAA and the marketplace subsidy cliff generally apply during different healthcare phases. You do not stack every possible penalty into one universal conversion rate. You follow the branch that applies to you. A Medicare couple watches the $218,000 modified adjusted gross income line. A pre-Medicare couple using marketplace coverage watches the applicable poverty level boundary. A household with a taxable brokerage account watches the $98,900 taxable income ceiling for 0% gains. A couple over 65 watches the $150,000 modified adjusted gross income line, where the enhanced senior deduction starts shrinking. Those lines use different definitions of income. That is mildly ridiculous, but it is also actionable. Your all-in conversion price is the ordinary tax on the next dollar, plus any additional taxable income created by a deduction phase-out, plus any healthcare cost triggered, plus the tax value of another opportunity displaced, plus applicable state tax. The investment return you give up on the money used to pay that bill belongs in the economic calculation too. If you pay $22,000 from a brokerage account to fund the tax, that money no longer compounds for you. The Roth receives tax-free growth, but the tax payment has a cost. When current and future tax rates are equal, the raw traditional versus Roth comparison can be close to a wash before these secondary effects, estate goals, and withdrawal rules are considered. At this point, avoiding conversions altogether can sound like the obvious conclusion that would repeat the same mistake in the opposite direction. The argument is not Roth versus traditional. It is optional income today versus forced income later. Leaving money pre-tax preserves your cash and your low tax opportunities now. It also allows the account to grow toward required distributions, narrower survivor brackets, and a future year when you may have less control. The right column of the ledger can become far more expensive than the left. Standard retirement advice often ends at max your pre-tax. 401k, take the deduction, and deal with withdrawals later. Tax deferral is treated as if it were tax elimination. It is not. You moved income from one return to another, and the future return may belong to a surviving spouse with half the bracket width, larger required withdrawals, and fewer planning years left. Knowing the tax rules and building an exit system around them are two different jobs. I built a digital book called The Exit Code as an analysis of 50 years of retirement data distilled into a mathematical framework for exiting the rat race. It connects your traditional, Roth, and taxable money to the years when deductions, Social Security, healthcare costs, and withdrawal rates overlap. I also cover the Social Security bridge for delaying benefits without draining the wrong account, and the dynamic withdrawal method that replaces the fixed 4% assumption when markets refuse to cooperate. It is built to turn maybe someday into a specific date using actual retirement data rather than opinion. You can get it for less than a dinner out through the link in the description. Every additional year changes the tax window, which is why the framework matters more than a generic retirement number. The government begins narrowing that window at the applicable required minimum distribution age. People born from 1951 through 1959 are generally on the age 73 schedule. People born in 1960 or later are on the age 75 schedule. That correction matters because many retirees still plan around age 70 and a half or 72. Using the wrong age can remove or invent several years of conversion capacity. At age 73, a projected pre-tax balance of $1.5 million creates an initial required distribution of about $56,600 using the 26.5 divisor. $2 million produces about $75,500. $3 million produces approximately $113,200. These are rounded screening amounts based on the standard uniform lifetime table. A spouse more than 10 years younger who is the sole beneficiary can require a different table. Investment performance, withdrawals, and prior conversions will also change the balance. The important transformation is from portfolio value to annual taxable income. $3 million sounds like an account statement. $113,000 arriving on a tax return every year feels different. The first required distribution is not the worst one you will necessarily face. The divisor generally declines as you age. If the account earns more than the amount withdrawn, the balance in future distribution can continue increasing. Once required distributions begin, you cannot convert the required amount itself. The RMD must be distributed. You may complete an additional Roth conversion during the same year, but the required distribution enters your income and consumes bracket capacity before that voluntary conversion. That ordering changes the strategy. Before RMD age, you may have a return containing a modest pension, interest, or no Social Security yet. After RMD age, tens of thousands of required ordinary income can occupy the space you want it to use. Time, therefore, changes the crossover, even when the balance is identical. A household retiring at 62 with RMDs beginning at 75 may have 13 years to spread conversions across lower brackets. A household reaching retirement at 70 and beginning RMDs at 73 may have only 3 clean calendar years. With a long window, you can make smaller annual conversions and stop before an expensive boundary. With a short window, meaningfully reducing a large account can require conversions of $100,000 or more each year. Those larger conversions are more likely to enter 22 or 24%, erode deductions, cross IRMAA, or displace capital gains. A short window can make aggressive conversion mathematically worse, even though the approaching RMD creates more emotional urgency. Urgency is not evidence that the price is favorable. The relevant balance is also not the amount on today's statement. It is your projected pre-tax balance at RMD, age after assumed growth, withdrawals, and planned conversions. Suppose you have $1 million at age 65 and make no withdrawals or conversions for 10 years. At an assumed 5% annual return, not a forecast, the balance at 75 would be about $1.63 million. The first RMD would be roughly $66,000 rather than the $41,000 produced by dividing today's balance by the age 75 divisor. Your crossover moved because the account moved. Use a range of return assumptions rather than pretending a spreadsheet knows the next decade. A lower growth path tells you whether conversions still work without a large future balance. A higher growth path shows the risk of arriving at RMD age with more forced income than expected. Filing status can move the crossover even further. While both spouses are alive, a married couple has a 12% bracket extending through $100,800 of taxable income in 2026. A single filer enters the 22% bracket once taxable income exceeds $50,400. That means $60,000 of taxable income sits inside the married couple's 12% bracket, but reaches 22% for a surviving single filer. The surviving spouse also has a smaller standard deduction and only one possible age-based deduction. Nothing about the account changed overnight. The tax container became narrower. This is one of the strongest reasons a conversion can make sense even when the joint lifetime calculation looks weak. You may be paying a moderate rate while both spouses can file jointly to reduce income that could later land on a single return. It does not mean converting everything out of fear. It means including the probability of survivor filing status compression in the future marginal rate. The conversion can be less about optimizing the couple's next 5 years and more about avoiding a tax spike during the survivor's later years. Social Security creates another moving part. The common claim that 85% of Social Security is taxed is incomplete. Depending on provisional income, none, some, or up to 85% of benefits can be included in taxable income. For a married couple filing jointly, the long-standing provisional income thresholds begin at $32,000, with the higher threshold at $44,000. These thresholds have not been indexed for inflation, which is a charming way of allowing more retirees to drift into taxation without officially raising a rate. Provisional income generally includes adjusted gross income, tax-exempt interest, and half of Social Security benefits. A Roth conversion increases adjusted gross income. It can therefore tax the conversion and cause more Social Security to become taxable during the same year. Future RMDs can produce the same interaction. A new dollar of RMD may bring part of another Social Security dollar into taxable income. In that range, the effective marginal tax rate on the withdrawal can exceed the published bracket. This is why you cannot calculate the future cost from the RMD alone. Baseline income determines how much Social Security is already taxable, where the RMD lands, and whether the surviving spouse faces a narrower bracket. The crossover calculation can now be built without a black box slogan. Project the pre-tax balance to the applicable RMD age using a reasonable range of assumptions. Divide that projected balance by 26.5 at age 73 or 24.6 at age 75 to estimate the initial distribution. That distribution stacks on projected baseline taxable income. The top portion reveals the future marginal bracket, with adjustments for Social Security, taxation, and probable survivor status. Your proposed conversion stacks on current income. Its all-in price includes the current bracket, deduction effects, healthcare thresholds, displaced capital gain space, state taxes, and the cost of paying the tax earlier. Then compare the next dollar on each side. This is a screening calculation, not a complete lifetime tax projection. It does not model every future law, investment return, death date, charitable gift, or spending shock. It does tell you whether an aggressive conversion begins with a favorable price or requires heroic assumptions to work. Consider a projected balance of $1 million at age 75. The opening RMD is about $40,700. If projected baseline taxable income before the RMD is $30,000 in today's dollars, total taxable income reaches roughly $70,700. Under the 2026 joint bracket structure, that entire RMD remains inside the 12% bracket. Paying 22% today to eliminate it would mean prepaying $22,000 per $100,000 converted to avoid future income expected to face 12%. Even if rates eventually change, the conversion begins with a 10 percentage point disadvantage before IRMAA, deduction phase-outs, or lost investment growth. Large conversions are difficult to defend in that setup. Small conversions may still work if you have unused 10 or 12% space today, if state residency will become less favorable, if heirs face compressed distribution rules, or if survivor income changes the future rate. The balance alone does not prohibit the conversion. It refuses to rescue an expensive one. Now move into the transition zone with a projected balance of $1.4 million at age 75. The initial RMD is approximately $56,900. Assume projected baseline taxable income of $55,000. The joint 12% bracket has about $45,800 of remaining space before reaching $100,800. Most of the RMD remains at 12%, while roughly $11,100 reaches 22% using today's boundaries as a screening tool. That produces a split decision. Converting enough at a low current rate to eliminate the top future dollars can make sense. Paying 22% plus secondary costs today to eliminate the portion expected to face 12% later does not. This is the practical meaning of the $1.2 million to $1.5 million warning zone. For many married retirees, the first RMD generated by that projected balance is not large enough by itself to force every withdrawal into 22 or 24%. Deductions and available lower bracket space can keep much of it cheap. The appropriate strategy may be a narrow annual conversion rather than a campaign to empty the IRA. You remove the dollars with a credible future high tax destination and preserve the traditional money likely to use lower brackets. The balance becomes more threatening at $3 million. At age 73, the opening RMD is about $113,200. Suppose projected baseline taxable income is $120,000. The RMD pushes total taxable income to roughly $233,000 in today's terms. The withdrawal begins in the 22% bracket, and its upper portion reaches 24% under the 2026 boundaries. If you recently retired with baseline taxable income of $40,000 and have a decade before RMDs, annual conversions using the remaining 12% space can be extremely valuable. Even conversion dollars entering the lower part of 22% may compare well against future 22 or 24% withdrawals, survivor compression, and rising RMDs. The larger projected balance does not make Roth inherently superior. It raises the future price on the right side of the ledger. That creates more room for the current price on the left to win. A $2 million balance can belong in either camp. At age 73, it produces an initial RMD around $75,500. With low baseline income, much of that can stay in lower brackets. Add a large pension, taxable Social Security, or survivor filing status, and the same RMD can become expensive. Age changes it. Income changes it. The conversion window changes it. Filing status changes it. Healthcare changes it. The crossover number is the result of those variables, not a substitute for them. Your annual conversion should continue only while the next converted dollar is cheaper than the future taxable dollar it replaces. If the first $30,000 of conversion fills a 12% bracket, those dollars may be excellent. If another $40,000 enters 22% but avoids future 24%, those dollars may still work. The next $10,000 could erase senior deductions. Another dollar could cross IRMAA. A larger amount could push long-term gains from 0 to 15%. The same conversion that was attractive at $30,000 can be destructive at $100,000. That is why filling a bracket to the top is not automatically efficient. The published bracket may continue, while your actual marginal price has already jumped. The goal is not to maximize Roth money. It is to preserve useful tax options. Traditional money can fill deductions in low ordinary income brackets. Roth money can fund large purchases or survivor years without increasing taxable income. A taxable account can provide basis, long-term capital gains, and another source of spending without turning every withdrawal into ordinary income. That combination is tax diversification. It accepts that you cannot know every future rate, market return, healthcare threshold, or family outcome. Instead of making one irreversible bet on a single tax system, you retain the ability to choose which account supplies the next dollar. I have spent more than 10 years running my own business around accountants and fiscal lawyers, and the lesson that survives every tax code revision is that flexibility has economic value. I also have multiple hundreds of thousands of dollars invested, so I am not treating this as a spreadsheet hobby. The objective is not winning an argument about Roth accounts. It is keeping more after-tax money available when you need it. Most bad conversions are not failures of arithmetic. They are brain problems. Tax-free sounds emotionally superior to tax-deferred, so people pay almost any current price to obtain the label. The immediate tax bill feels like responsible planning, while a future tax projection feels uncertain and therefore frightening. Uncertainty does not make the expensive option safer. It means you should demand a margin of safety before making an irreversible conversion. Subscribe if you want more decisions reduced to the number where the trade changes. Lazy investing built more fortune than crypto memes. The same patience applies here. You do not need the largest conversion your tax return can survive. You need the amount that wins the rate comparison. The best Roth conversion ends at the last dollar whose price today is lower than its expected price later. Cross that line and tax-free growth becomes a very expensive label.